Hi guys, this is Cashflow Maniac, your channel about personal finance, stock analysis and investment. My name is Florian and today we will have a look at Sony. First of all, we will have a look at the qualitative aspects of Sony. Next, we will check out the financial aspects, and in the end, we will sum it all up and see if Sony is a good investment for us or not. Let's jump right in. So Sony has the ticker of 6758 at the Tokyo Stock Exchange and the ticker of Sony on the New York Stock Exchange. They are working in the consumer electronics segment and were founded 1964 in Tokyo. The headquarters is still, as of today, in Tokyo, Japan. Sony has around 113 employees and the market cap sits at 102 billion US dollars. Sony is a big conglomerate that is working in several different segments. The biggest one here is the gaming and networking segment, but they are also operating hugely in the music segment, in producing movies and TV shows, in providing and producing the hardware and software that is necessary to film these movies and TV shows. For example, like these camera setups, but also headphones, microphones, and everything that you need for the TV production, basically. The fifth segment is the image sensor segment. And last but not least, they are also active in the financial service segment, like insurance or banking services. The financial service segment is mostly active in the home market of Japan. So let's start with the qualitative analysis. At first, we have a look at the different segments and how Sony is set up. So 1/3 of Sony sales comes from the gaming and networking services. So this is by far the most important segment for Sony. And you might also know this from the PlayStation Network, PlayStation games, and several gaming IPs like Horizon, Forbidden West, that are part of Sony, that belongs to Sony. Second, roughly 1/4 is coming from their financial service segment and also their image sensors segment. And last but not least, the entertainment and service segment, pictures and music make up for the rest. That's a little bit more than 1/3 of the share. In the last fiscal year, Sony had around 77 billion US dollars of sales in total. When we jump into the details of each segment, we can see that the sales by segment are rising up from fiscal year 2020, 2021 to 2023. In most of the segments, you can see a clear uptrend, which is very nice to see. But unfortunately, if we jump to the operating income of each segment, the picture looks a little bit different. In this case, it's all over the place, and you can see that Sony cannot translate the increase in sales to increase of operating income in many of these segments, especially where high capex costs or also investments in IPs or partnerships are needed to keep the growth and the long-term focus running for Sony. So especially in the gaming and networking segment, which we already established is the biggest one for Sony, you can see there was a big increase in sales, but unfortunately the operating income went also down quite significantly from the quarter fiscal year 2021 to the last fiscal year. Same is true for the picture segment. And if we have a look in the future numbers, Sony is also expecting that the image sensor segment will require a lot of capex, a lot of new productions in the next years. So this upwards trend in operating income for the image sector might not continue like this. We might also see a dip here. Unfortunately, when we look at the very last quarter that Sony reported, this is from the Q1 of the fiscal year 2023, you can see that basically the same trend is true again. We can see in most cases that the sales numbers went up, but unfortunately the operating income numbers, especially if you look at the total numbers here, it went down quite significantly, even though the sales went up. One thing I would like to remark on this case here also is Sony that is oftentimes reporting the OIBDA in their reports. That means the operating income before depreciation and amortization. As you know, most of the companies usually report the EBITDA instead. When we look at the overall market trends for the segments that Sony is operating in, we can clearly see that Sony is trying to push the gaming, pictures and music markets and IPs by abusing synergies between each of them. That means, for example, they are trying to use the IPs they have in gaming and also translate it to music sales or music streams in the end. This is especially effective if we look at the home Japanese market of Sony, where they are producing a lot of animes and animated shows, where it's quite easy for them and they are already quite successful to translate this to music streams. In the image sensor segment, we can see in the last years the trend to more and more image chips in different consumer devices. First of all, smartphones. And in the next years, we will expect that the AR and VR trend will continue, and each of these devices uses multiple image chips. And Sony is the clear market leader in this case, so Sony will definitely benefit of this trend. We will have a look at the expected growth rates for each of these markets in just a minute. I also put here the increased need for image sensors and advanced image sensors. And what I mean by this is not only the regular CMOS chips that we have in the consumer devices, in the smartphones and the cameras right now, but I'm also talking about the more advanced industries like automotive or industry where for example, highly sensitive sensors are needed, or sometimes higher integration to the sensor chip. Like, for example, additional AI chips that are integrated right in the image chip. Also, of course, Sony is already working in AI integration, not only in their games, but also in their hardware chip, as I just mentioned. For this, I just want to quickly have a look at the market trends. And we will start with the movie and entertainment market trend. And please ignore this number because this is only for the US market. But we can look up here and we can see that the market is expected to grow from 2022 till 2013 with a CAGR of 7.2% worldwide. As Sony is operating on a worldwide basis, I would always use the worldwide trends, not the US trends as mentioned here. For Sony's biggest segment, the gaming segment, the expected growth is even 13.4% from 2023 to 2030. And if we look at the image sensor market trend, this one is from Market and Markets, we can see that a CAGR of 8.1% is expected until 2027 here. So if we sum this up and also take into account that the gaming segment is the biggest source of revenue for Sony, we can estimate that the overall growth rate for all segments where Sony is active will be in the high single-digit percentage CAGR, at least until 2027 or 2028. After that, it needs to be seen. What I mentioned before and what I very much like about Sony is that they keep a very long-term trend and very long-term strategy. They are not only looking for the increase in sales for the next years, but they are working long time in advance. And what I want to show you here is, for example, they already introduced by 2020, in May 2020, they already introduced their first image chip with an integrated AI chip. And this can do several different applications and is even flexible. So you can even program it and change the AI algorithm while the camera is still operating. So it can be used for different use cases on different times of the day, for example. And you have a lot of different options available here. For example, you already have an image recognition part in this AI chip, or it can be used where you already tag the metadata of the image right to your image. You can also change like the color format to black and white or different color formats of the same image, or you can even use like face recognition to select certain region of interest of your picture in this example, you can see the face of the dog was just selected and the rest of the image was removed. The application where this is useful is especially in consumer observation, like measuring the behavior where you're shopping, which parts of the shelves you're reaching for, or you can generate heat maps in shops or shopping malls to see where most people are going, which is the way to go. What are the more boring parts of the mall, of the shop for the consumers, and what is most interesting for them. And as I said, it's very interesting because you can even use different of these applications in the same camera to different times. So you can switch around what you want to see and what kind of analysis you want to do with your chip. Another thing that I want to show you is the cooperation between Sony and Honda that they just announced by beginning of 2023. It's called Afila. And here Sony is working together with Honda in developing and maybe even producing these kind of highly autonomous driving cars. It's not fully autonomous yet, but we can imagine that Sony is aiming to fully autonomous driving cars with this, to first of all use their image sensors and advanced image sensors for the autonomous driving functions. But also if we look or if we think one step further and we think about really autonomous driving cars, then you don't have anything to do in the car anymore. So you have a lot of time, for example, to look movies, or watch movies, or play games. And Sony is in a prime spot for all of these applications to be directly integrated in your ecosystem of the car. So for example, you could already integrate your PlayStation network to the car to immediately play your PlayStation games, or watch your Sony movies in the car if you don't have anything else to do. So this again shows to me that Sony is really thinking long term, and they are trying to find synergies as best as they can between the different market segments that they can abuse. Another thing I want to make you aware of is that Sony is currently thinking about spinning off their financial service segments. I didn't talk so much about the financial service segment up to now, and this is exactly the reason for this. In the last corporate report, you can see that Sony thinks that a lot of investment is now needed to achieve further growth and expansion in the financial service segment in the medium and long term. And also they think in the medium term they need to consider that their image sensors and entertainment business will also require significant investments, and they even state here that the investments are entirely different scale than what they had before. So this means to me that probably a lot of investment and a lot of capex is necessary for Sony in the next years to keep growing. And they are thinking about spinning off their financial service segment and use the money for these additional investments in the other segments. And if we have a look at the financials later, we can see that the balance sheet of Sony is already quite leveraged. So this might be a very good idea for them. To finish up the qualitative analysis, let's have a look at the Porter's 5 forces and in the end the risk and the growth potentials we can see with Sony. So at the threat of new entrants, I think it is quite low because most of the segments where Sony is operating either require high capex. Usually they are highly competitive, but Sony is competing against usually large players in most of these fields already. So the barriers to enter these markets newly are very high, and therefore I think the threat of new entrants is quite low. On the other hand, as I said, the substitutes, the competitors of Sony are also quite big and also have good power on the market. So in this case, I think even though Sony is most of the time either market leader or one of the bigger competitors in their segments, the threat that they lose some market share against their competitors is quite high. So I put medium to high here. It depends a little bit on the segment where they are operating. For example, I think in the music industry, it's maybe a little bit higher compared to the image sensors and advanced image sensors because yeah, Sony is very innovative here and has very, very advanced sensors compared to many other players in the field. The competitive rivalry, as I said, is very high between most of these big, powerful companies. And the bargaining power of the customers is unfortunately also quite high. That is because Sony is operating very close to the consumers, and the consumers are usually kind of price sensitive. You are not willing to pay everything for a Sony smartphone, for example, or for the PlayStation. The bargaining power of the suppliers, on the other hand, is a little bit lower. It also depends a little bit on the segments which we are looking at. For example, in the image sensor and hardware segments, Sony is trying to choose medium-sized suppliers and to have multiple suppliers for the same thing. Therefore, the power of each supplier is not so high. On the other hand, if we look at the entertainment and the music industry, they are working with certain artists, certain IPs. And in this case, I think the artists have quite a high power to bargain with Sony. Especially now, if you look at the writer strike in Hollywood, for example, you can grasp the real power of the artists and the entertainers. So all in all, this gives me the picture that Sony is working in a highly competitive market. It is dangerous, and Sony has to take care to not lose any market shares. I mean, they are quite powerful and they usually have good strategies here, but still, they really need to watch their markets and look out for their competitors. When we look at the growth prospects and risk factors, I want to look first at the risk factors. And here we have, first of all, the currency risk. Might not be so high. I mean, Sony is a Japanese company and they are reporting in yen. But of course, they are globally operating, which means that a lot of their sales is not done in yen. So this risk is not so high, but I want to mention it here still. As we already established, Sony is working in highly competitive markets. So this is a big risk for them to lose market share here. When we look at the financials, we will see that the balance sheet of Sony is quite leveraged, which I don't like. And in their biggest segments, the gaming segments, we just recently saw the acquisition of Activision Blizzard from Microsoft, which makes Microsoft one of the strongest players in this field. Most of the hardware business is cyclical, so we also need to watch out for this. It's not per se a big risk, but it's something to be aware of. One thing that we definitely need to have a look at is that the CEOs of Sony Interactive Entertainment will retire in March next year. There is not a final successor appointed yet. So we don't know what will happen when the current CEO of Sony Interactive Entertainment will retire. So this is definitely something we need to look out for. And as I also mentioned before already, the high capex needed for the image sensor and also the entertainment business. They also pose a big growth risk for Sony. On the other hand, we have the high demand for image sensor that will increase. And the demand, I think, for these more integrated devices with more intelligence or better, more sensitive chips will increase definitely in the coming 10 years or so. Sony is working on developing new IPs and they are investing a lot in these new IPs. So they are trying to strengthen the whole ecosystem for entertainment, pictures, and music again. And they are trying to abuse these synergies between these segments and interlink them more closely. I already talked about the image sensor technology and the shift to more hardware integration, for example, the AI chips that we saw before. And another growth aspect could be the spin-off or partial spin-off of their financial service segment to lower the conglomerate discount and also to use the money they earn with the spin-off to fund some of their capex and investment needs. Now that we had a look at the qualitative aspect, let's have a look at the financial analysis. For this, I usually use Seeking Alpha, and these are the most important points I will look at. Before we have a look at the income numbers, let's have a look at the total performance of Sony compared to the S&P 500. In the last year, we can see that Sony did perform a little bit better compared to the S&P 500, although in the later half of the year the difference came down significantly compared to the first half of the year. When we look at the last 5 years, Sony did perform a little bit worse compared to the S&P 500, but again you can see that it was basically oscillating around the S&P 500, so it's a very similar performance. When we look at 10 years time, Sony was clearly outperforming the S&P 500. But the overall picture here looks to me that the total return and the performance did suffer a little bit in the last year, in the recent years. And especially when looking forward, this trend is a little bit worrying. So we need definitely to keep an eye out on this. When we look at our income numbers, for example, revenue and net income, there is no clear trend that I can see. Usually what I like to see is a clear uptrend for these numbers, but in this case it seems to be rather stable, and the same is actually true if we look at the net income numbers. Sometimes it's a little bit up, sometimes it's a little bit down. The overall trend is increasing, but there is no very clear trend line or anything that we can see here. And one of the most important metrics for me is actually the free cash flow. And even if we look at the free cash flow, we can see it's all over the place. So there is definitely not a clear trend. There's no increase in free cash flow. This is definitely not what I want to see. So when we jump back to my checklist, and my requirement for revenue growth is higher than 6% on a 5-year CAGR. Sony did achieve 7.3%, and on a year-over-year value even 24.5%, which far outshines my requirements. So we can definitely give a green checkbox for this. For the net income growth, my requirements is 10% on a 5-year CAGR basis. And in this case, Sony only achieved a 7%, and the year-over-year value only is 4%. So this is a little bit worrying. It's not very bad, but the trend seems to go down, especially in the last fiscal year. So let's give them a red flag, a yellow flag for this. The free cash flow growth was all over the place, as we just saw. And the 5-year CAGR is very small, only 2.3%, with the year-over-year value being minus 40%. So yeah, this is definitely not what I like to see. And Sony definitely gets a red flag for this. The free cash flow yield is quite nice at 5.3%. This looks quite fine, so let's give them a green checkbox here. And I already talked about the debt and the leverage balance sheet of Sony. And here I usually look at the long-term debt compared to the EBITDA. And I would love to be the long-term debt be lower than 3 times the EBITDA. In case of Sony, it's 11 times. So this is far above the requirement. And for this highly leveraged balance sheet, they definitely get a red flag from me. We also need to consider that Sony already mentioned in the corporate report a couple of times that huge investments are necessary in the next years. So it will be very hard for them to lower this leverage. I would rather assume that it will go up even more in the future. So we need to be very careful for this. Sony is paying a very small dividend of 0.66%. The payout ratio is actually below 10%, so very small. And they did increase the dividend in the last couple of years, and the 5-year CAGR of the dividend is a whooping 17%. This is insane, and this is definitely what I love to see. I don't require a high dividend yield. I like my companies to pay dividends, and I'm focusing much more on the dividend increase in the recent years. I don't need the money of the dividends right now, so I would rather have my companies increasing the dividends on a year-to-year basis instead of having a high starting yield already. The margins, especially operating margins and return of investments, they have been quite stable over the last years, but let's have a short look together on this. For this, I usually use TradingView, so you get 2 statistics and see on the annual basis. And then the parts that I look at is return of invested capital and the operating margin. Except the first year, you can see that it's quite stable. It's a bit fluctuating, and we have very strong years here, but usually it's slightly above 10% and yeah, stable between 10 and 14-ish%. So this looks not not very good, but it's still on an okay level for me. And the operating margins, it's the same. Especially in the last year, you can see that it was always quite stable, around 10%. In the recent year, it only came down to 8.9%, which is a little bit worrying. And if this trend continues, this definitely would not be good. I would assume that this is currently mostly influenced by the bigger stock and the higher inventories that are building up. So at the moment, this is not worrying for me, but definitely something that needs to be observed. So in this case, let's give them a yellow flag. It's not very bad, it's still okay, but it's not a green flag either. So if you look at the big picture for this, Sony has 2 red flags. This is already a definite no-go, and even 2 yellow flags, which doesn't seem so good. I do like the high free cash flow yield a lot, and I do like the high dividend growth a lot, and also the very small payout ratio that Sony still manages to keep. But the free cash flow growth and all the revenue and income growth, revenue growth is still okay, but even income growth is also not so good. And what I especially don't like is that the numbers don't show a clear trend every time, but they are fluctuating widely up and down. So you can definitely see no clear trend here. On the other hand, Sony is always focusing on the long-term growth and the long-term strategy of theirs. And I think this can be clearly seen with the focus on AI chips back in 2020 already, and this new focus on cooperation with automotive manufacturers to spread their whole infrastructure and all segments from entertainment, gaming, imaging, music, to incorporate it more closely to the cars, which I think is a good idea and might be a powerful move of Sony if they can succeed in this. So before finishing up, let's have a look at the discounted cash flow, and then we sum it up and see where Sony stands. So when we jump to my discounted cash flow Excel sheet, I plugged in the numbers that we just got from our 5-year CAGRs here, and I extrapolated them to the future. We also saw the income growth rate at least will be in the higher single digits. So we could increase this maybe a little bit. I'm not so sure about the free cash flow growth rate because of the necessary investments and so. And what I do here is I actually calculate 2 times different discounted cash flow modules. One time I use the net income growth rate, and I calculate with the PE multiple from the last 5 years average to the fair value. And the fourth model I use is the Gordon growth model, especially for dividend stocks. In case of Sony, this is a little bit hard to estimate because of the low yield, but the high dividend growth rate they showed in the last 5 years, which will most likely not continue like this in the future. But when we look at the summary here, we can see that Sony on the in this column, this is the fair value calculation that drops out of my discounted of my different fair value calculations. And on the right hand side, I include my margin of safety of at least 10%. So to me, it looks like Sony is about fairly valued right now, without including any safety margin. So when we look at the risks that Sony poses right now, especially with the higher capex needed in the next years and so on, I would definitely love to see them come down a little bit more before thinking about starting a position here. So before we sum it up, let's give me a short disclaimer here. This is not investment advice. I'm not a financial advisor. This is only for information and educational purpose. Investments in stocks, ETFs, or other funds have a risk of losing all your money. So please do your own analysis before investing anything. So to sum it up, I do like Sony's strong market position in different growth market. I do like the possibility for synergies between several of the market segments, and I do like that Sony is really looking into how to abuse these synergies and how to increase these synergies between all their market segments. I do like very much that they return a lot of capital to investors, not only by paying dividends, but also by repurchasing stocks, which is very nice to see. And as a long-term investor myself, I do like their focus on the long-term growth and the long-term business model instead of just short-term returns. On the other hand, the balance sheet of Sony seems to be very weak, highly leveraged, especially in the current economic environment. This is definitely con point. We cannot see a clear growth trend in their free cash flow and their revenues, at least. They have strong competition in most of their segments, and they already disclosed that high capex and investments will be needed for several of their segments in the next years. In addition to this, we have the uncertainties how they will proceed with their financial service segment, and we also have the uncertainties with the change of the CEO of the interactive entertainment segment. So because of all these uncertainties and no clear trend line, at least for me, Sony is right now not a buy. I will keep it on my watch list. I will check them out maybe next year again and see how they develop from here. But at the moment, there are just too many uncertainties for me. Before deciding for yourself, please do your own analysis and check the company for yourself. Thank you very much for watching, guys. See you next week. Bye-bye.